U.S. employers cut 23,000 jobs in July, the first monthly decline in years, missing forecasts of an 80,000 job gain by more than 100,000 positions. 3 days later, the S&P 500 closed at a record high of 7,757.64. Same economy, same week, two numbers pulling in opposite directions. If the labor market is shrinking, why did the stock market just have its best week since April? This is not a contradiction you can wave away with one headline. And it is not as simple as either side sounds. The jobs number is real and it is weak. The stock rally is also real. And it is not a vote of confidence in the economy the jobs report just described. It is a bet on what the Federal Reserve does next. You are about to see why bad news for workers can be good news for a stock portfolio. Why the unemployment rate ticking down that same week is not the reassurance it looks like. And where the real risk in this story is actually hiding. None of it requires you to distrust either number. It requires you to ask what each one is actually measuring. Non-farm payrolls. The Bureau of Labor Statistics count of paid jobs outside farming, private households, and a few other categories, fell by 23,000 in July. Economists had forecast a gain of roughly 80,000 to 86,000. The decline was led by government, which shed 53,000 jobs, along with a 19,000 drop in retail and a 40,000 drop in leisure and hospitality. A possible hangover from the World Cup tournament ending. Private sector payrolls alone actually rose by about 30,000, which means the headline decline is mostly a government and services story, not a broad private sector collapse. Wage growth cooled too. Average hourly earnings rose 3.2% over the past year, the slowest pace since May of 2021. Put together, this report describes an economy adding fewer jobs, paying smaller raises, and losing government positions faster than the private sector can absorb the slack. That is the plain reading. And it is the reading that moved markets. Whatever comes next in this story, start from the fact that this piece of it is not in dispute among economists. The number missed, and it missed by a lot. The market logic here is not new, but it is easy to miss if you assume stocks only rise on good economic news. Investors were not celebrating the job losses. They were recalculating the odds that the Federal Reserve cuts interest rates soon. Before the report, futures markets priced meaningful uncertainty about the Fed's next move. After it, pricing on the CME Fed Watch tool shifted sharply toward a rate cut, with the probability of a quarter-point cut at the Fed's September meeting climbing toward 88%. Lower interest rates make borrowing cheaper for companies, make future corporate earnings worth more in today's dollars, and make bonds less attractive relative to stocks. That combination tends to push stock prices up, which is exactly what happened. Gold rallied for a related reason, since it also benefits when rate cuts look more likely. None of this means investors think the economy is healthy. It means they think the Fed is now more likely to act like the economy needs help. The stock market was not grading the jobs report. It was pricing a policy response to it. The same report showed the unemployment rate edging down to 4.1%. A number that on its own sounds like good news layered on top of the payroll miss. It is not that simple. The unemployment rate only counts people who are actively looking for work and cannot find it. It does not count people who stopped looking altogether. The July decline was driven largely by a shrinking labor force, meaning fewer people were counted as job seekers, not because more people found jobs. A labor force that shrinks because workers give up looking produces a lower unemployment rate. Through subtraction, not improvement. This is one of the oldest traps in reading economic data. A single summary statistic can move in a reassuring direction for a discouraging reason. It takes a second number, the labor force participation rate, to tell you which story you are actually looking at. This month, the participation story and the payroll story point the same direction. The headline unemployment rate, read alone, points the opposite way. That gap is exactly where careless reporting turns real data into a false reassurance. A single month of payroll data is one of the noisiest numbers in economics. The Bureau of Labor Statistics revises these figures for months afterward as more complete survey responses come in, and prior months in this same report cycle were revised lower, meaning the picture you see today is provisional, not final. Betting heavily on what one report implies about the broader economy has burned forecasters before. There is also a real disconnect worth naming plainly. A stock market record does not mean the labor market is fine. And it does not directly help someone who just lost a government or retail job. Equity gains flow mostly to people who already hold stocks, a group that skews older and wealthier. Treating a record close as evidence the economy is strong, when the record exists because traders expect the Fed to respond to weakness, mixes up two different audiences entirely. And the Fed itself has not cut rates yet. An 88% probability is a market bet, not a decision. If the September meeting does not deliver the cut markets are pricing in, this rally has room to reverse. Here is the split most headlines missed. The jobs report is signal. Payrolls fell. Government led the decline. Wage growth slowed. And the unemployment rate improved for a reason that is not actually reassuring. None of that is noise. The stock market record is also signal. Just not signal about the same question. It reflects a rational bet that a weak labor market pushes the Federal Reserve toward cutting rates. And cheaper money tends to lift stock prices regardless of how workers are doing. Calling either number fake would be wrong. The mistake is assuming they have to agree, or that one cancels the other out. They are answering two different questions. How is hiring going? And what will the Fed probably do about it? Keep those separate and both numbers make sense at the same time. Collapse them into one storyline and you get a headline that sounds like a contradiction instead of two true things sitting side by side. Subscribe for more stories where the numbers are real but the popular reading of them is not. Signal from the noise. Every week.